Hello and welcome back to the Real Estate Roundup podcast. My name is Kobe Zinn and I'm joined here today by my co-host Andres Martinez. How's it going, Andres?
Great. Awesome.
Yeah, so it's I think it's been a good week for real estate as far as there hasn't been anything that has changed too much with the NAR lawsuit and rolling out all the changes, right? Lots agents are still out there doing real estate, people are still transacting, which is the positive thing about all of this. But I think for today's episode, we're going to be talking a little bit about what goes into your monthly escrow payments and then also how can you actually determine the affordability of a home. Are you looking at the actual price of the home or are you looking at the breakdown of the monthly payments? Because we want you to not just get into a home, but also, keep it for the long term as well. So I think we could just dig right on in on this, unless there's some updates you want to share for this past week in your business. That's anything interesting going on?
Nothing much as far as on my side. This everyone went back to school. I know the NAR changes did happen this week, but uh, there's not enough feedback to even update on that as at the moment.
Right. Yeah, I think there needs to be a lot more, a lot more business being done out there, and then the more that people are getting used to it, the more feedback we can get as far as the proper and standard way to go about real estate moving forward. But yeah, let's dig right on into today's topic, which is finding out how you can actually afford a home. So when you're talking to clients, Andres, are you helping them understand the difference between the actual price of the home and the monthly payments they're having to pay over time, whether if it's a 15, 30-year period, and what goes into determining which one of these goes more into determining how affordable a home is for a specific individual or family?
So, in my experience, just over the last couple of years, with interest rates going up and the market being a little bit more stagnant, what has happened is a lot of people have determined their affordability on the monthly payment. They don't necessarily go at top end of their budget at the moment. There is positive information and positive changes where the interest rates are trending down. Um, they were in the sevens. Right now, they're about 6.5. We're hoping for good news here in the near future. So, for those buyers that are on the sidelines, I think we're going to be in a better situation moving forward, and we're going to be able to see more affordability. So a lot of people are determining their affordability by their monthly payment.
Yeah, and I think that's the probably a better way to approach affordability when it comes to getting into a home as well, because you're paying that payment for a long period of time. And just kind of from your experience, what would you say to people who are, they're thinking about their monthly payments and, they understand there's going to be a lot of change as far as, and maybe in their income, right, might go up, might go down over time that they're paying off the home. What do you think is a good metric for affordability for somebody when they're looking at their monthly payments, and especially as they're looking at it not just in the present moment, but for the entire period of time that they're actually owning the home?
So the good thing is we have a lot of conscious people that are out in the market because the market is a little different in today's date. So people that are in the market are knowledgeable. They've done their research. They've gone through that phase where is it a good time to buy or not a good time to buy? So as far as affordability, um, you should always try to keep it under 30%, right? And understand your debt to income ratio. You don't want to have a $1,800 car note and then go buy the top end budget home and then leave yourself zero margin for error, right? So when purchasing a home, you got to take everything into account. You got to make sure your payments that you have existing as far as your everyday living, if you have a car note, if you have any added expenses, you got to tally them all up and then find a payment that you're able to comfortably move forward with.
Right. Because one of the big issues, right, we don't want anybody to get into a home and then not be able to stay in it or keep it. right? I think that's very important for somebody when they're thinking about their monthly payments moving forward and the affordability of a home as well. And, it kind of brings me to a good point, which is, with all of the, I guess, changes happening in the market, a lot of people believe that it's not, they can't necessarily afford a home at this point. But, what are some things that you would say affect the monthly payments when it comes to the actual real estate market and the pricing of the home, as well as the interest rates and all of the other things going on in the real estate market today?
So as far as your payment, I'm just gonna break everything down. So when people get a little bit nervous, is right now the interest rates have relatively been high. So I know I'm in the new home build side, so we are buying interest rates in the fours.
Mhm.
So one big factor on making a home affordable is that interest rate. If the lower your interest rate, the lower your monthly payment is going to be. And then additional factors, right? So your payment is your principal and interest, your escrow. Your escrow is your taxes and your home insurance. One thing that I tell people and try to educate people on is there is a homestead exemption. So after I would say you move into your home, you submit your homestead exemption, right? And then you're able to get a tax credit for that. Therefore, making your escrow, getting a discount on your escrow because you'll be paying essentially a lesser tax because your home will be get a tax credit on the evaluation. So let's just say I have a home that's 100,000 and the homestead exemption allows you to have 25, 40, 100,000. Um, you would subtract that amount and then you pay, so let's just say it's 25,000. I have $100,000 home. Um, now I'm paying taxes on 75,000. Therefore, bringing your escrow down as far as your overall for you to have in your escrow for your tax payments. So usually we pay taxes here in San Antonio every October, and then you pay your insurance once a year. The escrow account actually is a part of your payment, so you're able every month they'll put a little bit of money into that escrow account, and then when it's time for you to pay your taxes and insurance, it'll automatically be sent out. One thing that I tell people, and I've always educated people on, is make sure you understand your taxes because your home values will go up. So you might have to escrow a little bit more money as you, the longer you live in this home and the more equity you get in your home. And the overall evaluation. So if you moved in and your home is $100,000, let's just say 10 years later it's 150, right? And well, now you'll be paying taxes on 150, right? You will get your homestead exemption, but there was an increase in value, so there will be an increase in taxes. So you always want to review your taxes every year to see your home evaluation. So if you need to adjust your escrow, you're able to do that, therefore not causing any hardship in the future.
Yeah, that's very I don't think a lot of people understand that, right? They understand that home values go up. One of the major benefits of owning real estate is that, home values do go up over time, but if you're paying the monthly payments, right, your home value is your taxes are based on your home valuation. So if your home value is going up, your taxes are going up as well. So did you say usually that it's how big of an adjustment it is per month for somebody's home value going up, just standard, I think, across the board of kind of appreciation over time? Or is it something that people really need to budget for and worry about, or is this something that people can kind of, if they, with the proper planning, they can not
I
have to worry about losing the home?
So every time we're on the show, we're always explaining on how after COVID we went through a time where it was not normal, right? So home evaluations went up in the 20 percentile for a couple, like maybe 3 years. So a person that had a home that was $100,000, and 3 years later, it's $200,000. So those home evaluations skyrocketed. So people's escrow and taxes, they skyrocketed. So there's been systems put in place where the homestead exemption was 25,000 here in Bear County, and then it was moved to 40,000, and it still didn't give a relief where people's taxes had increased so drastically that they recently moved it to 100,000 homestead exemption. Um, there is some qualification measures. Most of the time, people qualify for the full amount, but I've heard circumstances where it's only a prorated amount. But that homestead exception change was made there to offset how drastic home values grew and how people's tax bills. So people went from paying minimal, well, I don't want to say minimal. Let's just say 3,000, and then a couple of years later, they were paying $5,800. It's a substantial amount. If you divide that, it's a couple $100, maybe even $300, right? So that's not the normal state of the market or the evaluations of homes. Usually it's 3%, right? In a good year. But for a couple of years there, it did go into 23, 18%, 20%. So it's always good to monitor them. So um, every year your taxes, because we want our property values to grow, right? So if your property value grows, which most of the time it's going to grow 3%, right? It's not a set number, right? A year it might be less, another year, like I just explained, it might be 20%, right? um, but just kind of understand your home evaluation so you can stay on top of your taxes. On a year to year, traditionally, a couple $100, right? 30, 40, 50, $60, depending on your home, right? We're talking about $1 million homes, it's different. But we're talking for the standard median home, maybe $60 a year, right? Is a good amount. But make sure that when you get your tax evaluations, usually around uh, June, July, that you see them so you can prepare for the next year.
Yeah, that's actually really good advice, right? For people to kind of just prepare for their taxes going up along with their property values as well. Which kind of if you're thinking about a lot of clients out there, I don't know if that's kind of what you guys are seeing as well from your side on the new build side, but I feel like a lot of agents they're working with clients who are maybe afraid to get into the real estate market currently because they don't want to get into a position where they can't afford the home as well. So, what are you guys doing to, I guess, calm those nerves of clients who, they want to get into a home, but they're just not 100% sure of, what are all the factors that affect their monthly payments? Should they be getting into a home currently? Or should they be waiting and seeing if they could possibly lower their monthly payments or maybe even later on?
So the number one factor when it comes to like home affordability at the moment is the interest rates. So if you're able to get a fixed buy down in the fours, uh, no one foresees the market dropping that drastic over the period of the next 24 months. Um, can it happen? Yes, it can happen. No one can ever predict interest rates, but the data doesn't show that it's drastically going to drop or if it'll ever drop right back into the fours. So if you have a builder out there that is actually promoting a 4.99, a 4.25, a 4.5, that's actually a very comfortable interest rate for this market, right? That's going to make a home more affordable. It'll probably drop the payment a couple of $100. And I think that's the number one factor when it comes to home affordability is that interest rate.
Yeah. Interest rate is the one thing that's I think that's going to be variable, right, over time and it changes a lot. So currently we're sitting at, probably not the best interest rates for, a lot of people's opinions. Again, we talked about this quite a bit on the show as well, with different changes to the interest rates throughout the weeks. So, is there any potential for people to lower their interest rates as they own the home, right? I know there's different strategies like refinancing and different things that they can actually get their interest rates lowered. So, is there actually strategies for you to lower your monthly payments after you've actually bought the home and live in and started to live in it?
Yes, you can always refinance. Like right now, Kobe, we're like, hey, 6.5. We're actually not far off of a normal market. A normal market's usually in the 5 to 6, right? So 5.5, 6% interest. We stepped out of the norm drastically right after COVID, right?
Yeah.
So a lot of people have that in their head, like, when are we going back to twos? When are we going back to threes? Those are likely not going to happen anytime soon, if they ever happen, right? So the thing is, once you move in a home, so I hear people say marry the house, date the rate. Yes, you can date the rate and refinance it. There is a lot of deals out there, guys, where a lot of these new home builders are buying down the rates. So you could marry the home and marry the rate at this time, in certain circumstances. Another way, if you're like in the existing market, one thing that you can negotiate is concessions. So let's just say it's a 6.5 today. The seller can contribute a certain amount towards buying down your rate. Could that bring it down into a 6.25 or 6%, or maybe even into the fives? It will cost a certain amount of money. You're able to pay that up front just to buy down the rate to a more affordable rate. So there is different strategies that you can do it where you can secure a lower rate now. It's just, if when you're on the existing side, this is where the realtors value, right? They're going to guide you through that process. They're going to be able to negotiate that for you, right? If they're understanding, hey, this is my budget, this is, they might be able to negotiate a rate that fits your budget, therefore making your monthly payment affordable for you. So there is ways to secure a lower rate at this moment, and it's through rate buy downs and through concessions on the existing side. And there's already rate buy downs that builders are doing. It does cost the builders money to buy down your rate, and even on the existing site, there is ways to buy down that.
Yeah. So there are ways to lower your payments, right? There are ways to lower the interest rates and be able to do that. And really just to kind of, make sure that everybody understands, what goes into their monthly payments. Is there any other payments that goes into a monthly payment on a home that you think people tend to miss, or different things that people aren't, they're not necessarily privy to before they actually purchase the home?
So one thing that I always tell people uh, is understand the loan, right? So when you get with the mortgage company, understand what loan you're going to get. Um, FHA loans have mortgage insurance that is a specified amount extra per month. And then, but it's actually the most common loan. It's actually one of the best loans. It's what's making it possible for people to purchase homes. So the FHA loan is probably the most popular loan, but there is a mortgage insurance added to it, right? And it could be 100, $115. But understanding that, then you have conventional loan. On a conventional loan, if you put 20% down, uh, you won't have to pay that added fee. So it's practically an insurance for the mortgage company if that loan should ever default.
Mhm.
So on a conventional, if you pay 20%, or once you pay 20%, uh, that comes off of your monthly payment. So that's one thing that people, it gets overseen. With the VA loan, there is no mortgage. I mean, mortgage payment insurance for that. So there's no MIP for a VA loan. On a VA loan, there is no down payment. So how does someone from the VA, how can it be made affordable for them to purchase a home? Well, if there's no down payment and you could get a builder to pay your closing costs or most of it, right? Or if you can get your sellers to pay some of your closing costs, therefore making it as minimal as possible. That's an option to make it affordable for veterans and service members.
Yeah. So again, there's a lot of different options out there, right? You have to make sure that you understand everything that's on the table, so that way when you do go into a home, everything is there's nothing necessarily catching you by surprise, right? So there's a lot of different ways for people to actually start affording a home, different products that are out there, and it's just understanding, having the knowledge and the education in order to make the best decisions. So yeah, Andres, was there anything that you wanted to kind of add before just we wrap up for today on this topic?
Just understanding, for everyone to understand, like, hey, there's different programs. Find the program that best works for you. If you're on the existing side, um, make sure you get a good realtor. If you're on the new home sale, make sure the communication, the questions are asked. Have that sales rep explain the payment to you. They're going to be able to give you like a broad spectrum of the payment. But if you have questions as far as your mortgage, the best person to answer that question is always going to be the financial team, right? You work with a new builder, they're going to have a financial team. They're going to be able to answer the questions. They're going to be able to break down the payment from point A to point B to every aspect of how does closing costs. They're able to break down the whole transaction for you. They're really good. They do it every day, so they have that information. Same thing with an existing side, right? Talk to your realtor. Your realtor will give you the broad spectrum. They'll break down most of the information, but they have a mortgage team for the more intricate questions when it comes to financing. The mortgage team is going to find the best program for you, right? For some people, it might be conventional because they got 20%. For other people, it might be FHA because they only have 3% to put down on a home, or 3.5. And there's always programs that are transitioning through, right? Sometimes there's a conventional at a lower rate. Now, would you get rid of that MIP if you get a conventional um, and you don't put 20%? Because you could get a conventional and not put 20%. Yeah, you'll get a conventional loan, but it will have that specific fee until 20% is covered.
Right. Exactly. So that's awesome, man. Thank you so much for sharing. What you shared today. I think it's imperative for people to understand. There's different ways for you to go in there and actually help you, afford a home. And again, make sure to talk to the professionals who are actually going to help you with that, right? For buying an existing home, even a new build home. Having a real estate agent is always going to be, beneficial for you because they represent you and they're going to be there to help you negotiate and point to the right resources and talking to the right people who can help you with your with your purchase of your home, but also with the loan on that as well and the monthly payment. So Andres, man, appreciate you for sharing that today. Appreciate you being on the show, and appreciate you all for tuning in. Make sure to reach out to Andres in the description of the show notes down below if you need a real estate professional to help you out. But other than that, I will see you guys on the next episode of the Real Estate Roundup. Take care.
Take care.